Hello and welcome back to FT Trading Room. We've been discussing the impact of high-frequency trading as European parliamentarians prepare for a busy summer, crafting their response to the proposals for the MiFID review. Finance Watch, a consumer lobby group in Brussels, recently made several recommendations to regulate high-frequency trading. With me to discuss them is Benoît Lallemand, the Senior Research Analyst at Finance Watch.
Thanks for having us.
Welcome, Benoît. First of all, you guys have only been around for a year. Briefly tell us who you represent.
Yeah, so we are a non-profit, non-partisan association. We were created a year ago with a mission to promote public interest in the field of financial reform, so to kind of bring a balance to the debate on financial regulation. Because it was felt to be too skewed to one side? Well, most of the lobbying happening today in Brussels is performed by the industry, and we really find that the industry defends their private interest, but we just think there should be a balance, and that public interest, in fact, is not just the sum of private interest. Okay. Now, within these recommendations here in this report that you come up with, there are some curbs on the high-frequency trading here. I mean, do you accept some of the arguments that the industry make that actually they actually contribute to tightening of prices and improve volumes? Mm-hmm. Well, in fact, when it's about high-frequency trading, or for that matter, any other market practice that is looked at in MiFID, we like the idea that it's about a cost-benefit analysis for end users, really. And when it comes to high-frequency trading, what we see is that on the benefit side of the balance, for us, there's very little, while on the cost and risk side, there's a lot in terms of cost of infrastructure, cost of surveillance, and other items. So on the benefit side, you mentioned the costs. The evidence we look at is that the cost of trading for institutional investors has gone up since MiFID 1, 14%, because of the smaller size of transactions. So in terms of value of trading, it costs more. Now in terms of reducing the spread, we understand it's only one part of the quality of liquidity. And next to that, so to the price, you also have the volume you can trade, the firmness of your quote, which is really the volume, the resting time in the order book, and last but not least, your ability to absorb some of the imbalance in terms of market instability with your inventory, which high-frequency traders do not do because they don't keep inventory. So basically, in terms of the quality of liquidity, we believe even if the spread has been tightened a little bit, overall it's been damaged because the three other dimensions have been damaged by high-frequency trading. Now, I mean, one of the main thrusts of this paper has been to talk about making markets serve society. I mean, yes, do you actually think that a lot of what high-frequency trading does actually serve society? Well, as I just mentioned, we're not convinced, but we really should make a difference between computer-assisted trading, which is fine because obviously, as in any other business, it lowers cost, automation lowers cost, and the more predatory practices that high-frequency trading performs, and the reason why they need microsecond or nanoseconds trading, and on this part, including the market-making part, we're not sure it contributes to healthier markets. Let's talk about some of the recommendations that you made here. What's your key views? Well, we think that basically there are two items to address. One is the integrity of markets, everything related to market abuse, and that's probably the order to trade ratio. Another aspect is what I discussed, is the quality of liquidity that is provided, and there is more resting time in the order book. As I mentioned, and other measures. We like not to focus on one measure, and we understand that ideally MiFID II should bring a complete toolkit to the regulator at national and European level to be able, as evidence comes forward on high-frequency trading, to calibrate the controls over this activity in the future. So we'd rather have a regulator that is able to manage the tick size, the price on messages, so the fee structures, the resting time, and other measures that like continuous trading during the day. Well, whether the regulators are able to take on that toolkit and whether they have the resources will be another question. Benoît, thank you very much. Thanks for having us.